The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everyone. Thank you so much for joining us this morning. My name is Jennifer Vivian, and I'm the Manager of Entrepreneurial Services at the City of Brampton's Entrepreneur Centre. I'm delighted to be hosting this webinar this morning on the topic of selling online, tax obligations you need to know. We want to first bring great attention to our partners today, MNP and Startup Peel. This session would not be possible without their support. MNP is a leading national accounting, tax, and business consulting firm committed to supporting Canadian business owners and communities. The firm created the MNP COVID-19 Business Advice Centre to provide timely insights and practical solutions to help organizations navigate uncertainty and adapt to the evolving landscape. Their experts across the country are closely monitoring the rapid changes to provide up-to-date content that is relevant to businesses in our communities. Startup Peel is a part of the Startup Canada community. It's a grassroots-driven movement bringing together people passionate about collaboration, innovation, and learning. Their mission is to get people together to support one another as we create fantastic new companies in our region and across our country. Before we begin, we'd like to go over a few housekeeping items to ensure that this morning's webinar goes over smoothly. A copy of today's presentation is available in the handout section of your participant control panel. We will also be emailing everyone after the presentation with a copy of the presentation, along with a link to the recording of today's webinar. The presentation this morning is approximately 45 minutes, giving us time at the end for Q&A. Everyone on the call has been muted to avoid any background noises. If you have a question or comment, please use the question box in your control panel to ask your question. We have a full agenda this morning, so if we are unable to get to your question at the end of this session, we will follow up with an email, or you can reach out to our speakers directly. Their emails will be provided at the end of the presentation. I would now like to introduce our speakers this morning. First off, we have Anny Joshua, who is a senior manager in the Mississauga office at MNP. Since 2002, she has been providing sales tax advisory and compliance services in public practice. She helps clients understand and implement Canadian sales tax applications tailored to their business needs. As a sales tax advisor, she helps her clients to understand the Canadian sales tax rules, how the rules are applied, and how to manage sales tax accordingly. Next presenter this morning is Tony Marchegiano, is a partner in MNP's Mississauga office and a member of the firm's international sales tax services team, specializing in U.S. corporate tax. Tony draws on his knowledge of U.S. federal and state law, his training as a U.S. tax specialist, and his extensive experience in developing cross-border solutions to help multinational and owner-managed Canadian companies stay in compliance with current legislation while minimizing taxes. Without further ado, I'll let Anny and Tony take it away. Thank you.
Great, thanks so much, Jennifer. So welcome everyone, I'm Anny Joshua, and I'm here to present to you some of the sales tax concepts or matters that you need to be aware of for selling online in Canada. So I'm going to go over some of the landscapes that we have right now in Canadian sales tax, the basics of GST HST, registration for the GST HST as an online retailer, what to expect once you're registered. I'm going to touch on a couple of Canadian sales tax matters other than GST HST, such as QST, which has a new registration regime. The PST, we'll speak briefly about the registration requirement for the provinces of BC, Manitoba, and Saskatchewan. The invoicing requirements that's needed as a registrant, and just some pointers about filing your tax returns once you become a registrant for the GST HST or the PST in Canada. Jennifer, can you help me with the slides here? Oh, there we go. Okay. So there are 5 sales tax jurisdictions in Canada right now. We have the federal GST HST, and that's administered by the CRA, Canada Revenue Agency. We have the Quebec Sales Tax, QST, and that's administered by Revenue Quebec. And Manitoba, Saskatchewan, and BC, each of these provinces have their own PST ministries that administer to each of the provincial sales tax. So HST, the Harmonized Sales Tax, is a value-added tax. It occurs in 5 provinces. When you're registered for the GST HST, it's done through the CRA. You file one return, even though there are different rates of tax. So as we are all mostly aware, in Ontario, we have a 13% HST. There's also a 15% HST, Harmonized Sales Tax, in the provinces of Nova Scotia, New Brunswick, PEI, and Newfoundland. And the rest of Canada has a 5% GST rate that is applicable as well. So PST, like I mentioned, is a provincial sales tax or retail sales tax. And these retail sales tax only apply for retail sales, so end consumer tax. Plus, we also have the Quebec sales tax in Quebec. You would need to register with each applicable province if required and file a separate return for each province. It's important to keep track of different PST that you're collecting and to ensure that you're remitting the correct tax to the correct entities. In my experience, we have some clients where they're registered for a number of PST and GST and QST, and there are times where they would remit the wrong tax to the wrong government entities, and at the end of the year when we try to fix it, it becomes a bit of a project for us. So you need to ensure that you have the correct accounting system to track these taxes separately. BC, as I mentioned, has a 7% PST, Saskatchewan has a 6% PST, and Manitoba has a 7% PST. The Quebec sales tax is also a value-added tax, and the current rate is at 9.975%. And again, you would register with Revenue Quebec separately and file a separate QST return. Here's a map showing the current rate across Canada, and as you can see, we've touched on all the different rates across Canada that needs to be reviewed when you're selling online in Canada. So the basics of GST. So the GST, as I mentioned, is a value-added tax. It's a transaction-based tax. So each transaction, each sale that you make needs to be considered whether the tax applies or not. And the sales tax base is very broad, and most things are taxable, as you're probably aware. So whether it be goods, services, intangible property, such as non-custom software or electronic files, intellectual property, such as patents and royalties, memberships, and sometimes real property may be taxable. What isn't taxable is very specific, and it's listed on Schedule 5 and Schedule 6 to the Excise Tax Act. So things like financial services, supplies made by charities, and certain healthcare services do not attract tax. And it's important to remember that there is no exemption for sales to resellers. So whether you're making a B2B sale or B2C sale, GST or HST could apply. The place of supply rules are unique when compared to most other VAT countries in the world because we do have 3 different rates of tax. And these rules basically just tell you when to charge the tax and which rate, 5%, 13%, or the 15%. These rules have been around since April 1997. However, there was a major overhaul about 10 years ago on July 1 of 2010. So for example, the rules for services are extremely complex. There could be 18 different subset rules for services as compared to 3 in the past. So for most of us who are online retailers, we're most likely to sell goods. So tangible goods such as lip balm, calculators, maybe even face masks. So for sale of goods, it really depends on where is delivery. If you're shipping from your warehouse and you're directly responsible to ship it to an address of your customer who's ordered the masks, for example, then you would charge the tax based on the delivered address. So for example, if a customer in BC, Vancouver orders a mask from you as a retailer whose warehouse is in Ontario, And as a seller, you're responsible to ship it to the Vancouver address. The delivery takes place in Vancouver. You would charge tax at 5% GST, even though you're located in Ontario. You also need to consider, well, what if my customer picks up the goods at my warehouse? I've been trying to buy a kettlebell for like the longest time since COVID started. I finally found one, and the only thing was that I have to pick it up at the store. Unfortunately, it's all the way in Saskatchewan. I'm not going to be able to do that. But had I gone to pick it up there, they would charge me a GST rate of 5%, even though I'm in Ontario. For IPP, it usually depends on the customer's address that you obtain on the agreement as to what rate of tax to charge. So IPP means intellectual personal property, and it could include things like ebooks, software subscriptions, or online courses. For services, it's the same as IPP. It would generally depend on where your customer is located, but you'll need to double check on those 18 rules that could also apply, as I mentioned earlier. It's really important to characterize the supply. What is the supply that I'm making? Is it goods? Is it services? Is it IPP, or could it be a combination? As the rules for charging the right rate of tax depends on what is the supply that is being made. Registering for the GST HST for online sellers. Generally, Canadian businesses on an associated basis, so you're not just your own business, but any business that you're associated with, where your sales is $30,000 or less, you're generally not required to be registered for the GST. So you need to consider, well, does my business, including my associated entities, have sales of more than 30,000? And if the answer is yes, you'll have to register for the GST HST and charge the tax accordingly. You need to consider that it includes both online and in-store sales. So you may have, with COVID, a lot of stores also offer online sale of their goods, as well as storefront sales. So you need to consider both online and in-store sales. Your GST number can be opened with the CRA under the business number application. And the business number is your federal your federal tax ID number assigned by CRA. And your GST number will be followed by the nine-digit business number that's assigned, followed by RT0001. RT is for GST HST. So let's go through a couple of examples of when you're required to be registered for the GST HST. So on February 1st of 2020, you started to a business, online business that you sell coffee mugs under an IP address, coffeemugsforyou.com. You looked at your sales at each quarter and you monitor whether you're hitting over the 30K. So at the end of the year, we're just under the 30,000. So as a result, we're not required to be registered for the GST at this time. However, you may voluntarily register for the GST even if you don't hit the $30,000. So a lot of startup companies would want to consider registering for the GST even if you haven't made a sale, because you are in commercial activities. You are going to be incurring inputs or expenses where you'll be charged the tax. And as long as you're registered at the time of incurring these inputs, you'll be able to claim back the input tax credits for the GST that you paid as a refund when you file your return, even if you've not made any sales. Second example, again, you're selling coffee mugs online. And here, the first quarter, you made $2,000, second quarter, $12,000, and on the third quarter, on July 1st, you received a big order for $31,000 for these mugs. Perhaps it was a Canada Day order. Because you've hit over the 30,000 in the third quarter, you are required to be registered for the GST on July 1st. You'll need to call the CRA or start the application for July 30th to register for the GST, and you'll need to charge the tax on the $31,000 sale. So what to expect once you're registered? So we go back to the example of buying and selling mugs online. So generally, Retailers or vendors would buy their products from other countries, such as the US or Europe or China. So when that happens is when the goods come into Canada, GST is paid at the border by the seller or the buyer of the goods entering into Canada, other than zero-rated items. So zero-rated items would be things like medical drugs, or it could be things that are just zero-rated under the Schedule 6 of the Tax Act. But generally, things that you would sell would be taxable, and there's a GST paid at the border. And it's a 5% GST that must be paid upon importation. And if you're already registered at the time of import, you'd be able to claim back that GST, the 5% that you paid, as a refund when you file your return. Carrying that same example, you're selling these mugs to Canadian customers. And again, depending on where the delivery addresses of these mugs, you would need to charge the GST or HST based on where the goods are actually delivered to. And there are 3 different rates of tax that can apply on the supplies made in Canada. If you're selling goods internationally, say you received an order from Florida, that would be considered an international sale. And if you're responsible to ship it to an address in Florida, then you're no longer required to charge the GST, HST, because that's considered an exported sale. If you're performing services online for customers in Canada, even if a part of the service is done in Canada, the whole contract of service is deemed to be taxable. So for example, online service providers will collect tax based on the province of their customers or buyer as per your service agreement. If you're an online business in Ontario and you're providing consulting services to a customer in Vancouver, you will need to charge GST at 5% as your customer's location is in BC, even if your services are performed in Ontario. So let's talk about some other Canadian sales tax that we need to consider. The Quebec sales tax and the other 3 provinces PST. Again, you need to determine separately if you're required to register for QST or any of the other 3 PST provinces. As you register for each province as required, separate returns have to be filed, and remittance to each province is done separately on those returns. And there are special registration rules for each province that I will touch on as well. So Quebec, Manitoba, Saskatchewan, and BC. Quebec has recently implemented a new specified registration system, and the other provinces, Manitoba and BC, will generally look to see whether you're selling goods to consumers on a regular and continuous basis in the province. So for Quebec, this came about because of Netflix. Revenue Quebec was not happy that consumers or Quebec residents were buying Netflix subscription without paying any QST. So on September 1st, 2019, if you are a resident of Canada, so a Canadian business, and you sell digitized goods or services to Quebec consumers, so these are individuals, you will have to register under a specified registration system. This applies even if you don't have any physical presence in Quebec, and there is a threshold or revenue consideration that will apply. So if your sales to Quebec residents is over $30,000 a year, and the customers are not registered for the QST, so just think of individuals such as myself, if I live in Montreal, then as a vendor, you have to register for the QST under this new regime. And it's from the first day of the calendar month in which your sales exceed 30,000. So what are these digitized goods or services that you ask? Well, if you're selling cloud services, music downloads, software, or entertainment products, so if you're selling an app, perhaps, where you will have Quebec residents or individuals downloading onto their phones or iPads or computers, then that would be considered digitized goods and services. And once you're registered under this new system, you'll be assigned a QST number with the prefix NR as a non-resident of Quebec. In June of 2020, Saskatchewan Finance also issued a new notice that it's specific to non-resident vendors. So these are businesses that actually have no physical presence in the province. So non-resident businesses that make retail sales to Saskatchewan customers, so these are your B2C sales of goods, taxable services, or leases of taxable goods, must register and collect and remit the PST. There are certain exceptions that apply if you sell from your home or to other individuals on a small scale or on a non-commercial basis. So if your annual sales are less than $10,000 and your goods are produced from your home, and you've paid PST on the equipment or the supplies that you've used in making these goods, then you do not need to register. As I mentioned before, BC and Manitoba would look to see whether you're regularly selling into the province for B2C sales. So what they would consider is if you are selling taxable goods to customers, including software and goods. So if they first have to look to see whether the goods are taxable or not. You accept a purchase order for these goods from a customer who's in BC. You're responsible to deliver the goods to BC or to a location in BC. You solicit business in BC, and it could be any sort of solicitation, whether it be advertising by mail, fax, or if you take out an ad in the BC newspaper, or you have a website that's directed at the BC market, that would be considered targeted solicitation. Or if you hold goods in inventory in BC at the time of sale, you're also required to be registered. So Manitoba has the same kind of 4 or 5 factors to look at to determine whether there's a registration requirement. So to think of this, if you're selling through Amazon, for example, and you know that you have some inventory stored in the warehouse at the Amazon warehouse in Vancouver, and you're going to be targeting your customers in BC, you're going to be accepting orders from them, then as you're doing this on a regular and continuous basis, then you're likely caught to be have the requirement to register in BC. Some information that you would need to provide on a sales invoice as a registrant. These are kind of the rules that you have to comply with once you become registered for the tax. So for example, as a GST registrant, you'll have to show your business name and your registration number, or if you're registered for the QST as well, you have to show your QST registration number. You have to provide the invoice date, the total amount payable, the tax amount that's payable, and the GST rate that's applicable, or HST rate that's applicable. And if the sale invoice itself is over $150, you'll have to include other things like your customer's name, a brief description of the goods or services, and the terms of payment. And don't forget, the tax also applies to shipping. I know a lot of the American vendors are surprised that we need to charge tax on the shipping charges as well. So GST, HST could apply on the shipping charges, and so would PST. And PST is charged on the subtotal before the GST. And some provinces also require PST to be charged on shipping. Now that you've registered, you need to file your returns. Your filing frequency will depend on your expected sales and revenue when you first register for the tax. So for the GST, HST, and the QST, you could be filing an annual return, a quarterly return, or a monthly return, and it depends on your expected revenue. If your revenue is going to be under 1.5 million Canadian, then you will be assigned an annual return. If it's between 1.5 to 6 million, then you'll be assigned a quarterly return. If you're more than 6 million, then you'll be required to file a monthly return. You can always request to file more frequently, but not the other way around. The returns for annual returns are due 3 months after the year end. So for example, if you're registered for January 1st, your first reporting period would be January 1st to December 31st. It will be due by March 31st of the following year. For quarterly and monthly returns, they are due the following month of the reporting period. So for example, Q1 January to March, it will be due the end of April. If it's January 1st to January 31st, it will be due the end of February. And for the provincial sales taxes, again, it really depends on your expected threshold as you register for the sales tax. And I've labeled, or I've provided a chart which kind of determines what period you're required to be registered for. Manitoba and Saskatchewan, I'd like to point out that the reporting deadlines is on the 20th of the following month, 20th day of the following month. And BC, it's like the GST and the QST, where it's due the end of the following month. So I hope I have highlighted to you some of the sales tax, Canadian sales tax considerations as an online retailer. Now I'll pass it on to Tony to address the US side.
Thank you. So Jennifer, I can't, okay, there we go. Okay, thanks everyone. I'm Tony Marchegiano. I'm the partner in the US Corporate Tax Group in Mississauga, and I'm gonna go over the state sales tax. So at the end of the day, what you should get out of this, if you're selling online to US customers, whether you're a Canadian or a US company, you will need to charge and collect state sales tax if you meet certain sales threshold levels in a state. And that's under the new Wayfair rules that came into effect in 2018. So if you meet these sales threshold levels, you're gonna have to charge and collect state sales tax. And the sales threshold levels are typically $100,000 of sales in a state or 200 transactions. And it'll vary by state, and we'll go through it. So that's the big case, the Wayfair versus South Dakota, and we'll go through that. So can I move to the next slide? Okay, so let's just take an overview of state sales tax in the US. So approximately 45 states impose a sales tax, and those range from 4 to 10%. And the seller simply collects and charges the sales tax to the customer and remits it to the state. So there's no credits, input credits or anything. You just charge, collect, and remit it. State sales tax are imposed on the retail sale or rental of tangible personal property to an end user within the state. So the key words there are retail sale to the end customer user. So you only charge sales tax to the end customer user. If you're selling to a reseller, you don't charge the sales tax, the reseller does. And it's based on tangible personal property, which is something you can touch. And then some states tax specific services, and it's really state specific. So for example, a state might tax 10 services, and they might, for whatever reason, tax haircuts. And yeah, it's very state specific. With respect to Canadian companies typically provide consulting type services, and those are generally not subject to state sales tax. Okay, so in order to charge and collect state sales tax, you need sales tax nexus, which is a minimum connection with the state. So there's two types of sales tax nexus. So historically, there was physical presence, and that still continues to be the law, but that was the law of the land for up until 2018, and it continues to be the law of the land. If you have a physical presence in a state, you need to charge and collect state sales tax, like inventory, property, employees, agents, an office. So if you have a physical presence in the state, you need to charge and collect state sales tax. So basically, internet, up until 2018, when the Wayfair rules came about, internet companies were not charging state sales tax because they wouldn't have had a physical presence in the state. So they had an advantage. And then Wayfair came along, and that was a Supreme Court decision, and that extended the sales tax nexus to economic nexus, which is basically sales threshold levels. So as I said, if you meet these sales threshold levels, and we'll talk about that, you need to charge and collect state sales tax. So that was a big decision that came out in 2018. So prior to that, you needed a physical presence. And you still do. If you have a physical presence, you have to charge and collect state sales tax, or if you meet these sales threshold levels, you need to charge and collect state sales tax. Next slide. Okay, as I said, so sales tax is based on sales to end users. So if you're selling to distributors or resellers, those are exempt, but you need to collect a reseller exemption certificate. You need to keep those on record in case you get audited. You can tell the state that they're exempt because they're resellers, and the reseller would charge and collect the state sales tax. So state sales tax varies by state and municipalities. So typically a state tax will be like 5%, but there's typically a local tax too, based on the jurisdiction. So whether it's a city tax or a municipality tax. So if the state tax is 5%, it usually adds 1 or 2% for local taxes. And the characterization of a transaction as taxable sale can vary by state. So again, it's based on tangible personal property, but a lot of states will have exemptions. So some states will exempt food, clothing, drugs, that type of thing. So it's very state specific. There's a lot of exemptions, and the first one we'll go through is the status exemptions. So sales to non-for-profits are not subject to state sales tax, and those are referred to as Section 501c3 organizations. So non-for-profits are not subject to state sales tax. Either are government agencies, they're not subject to state sales tax. So that's both the federal and state local agencies. They're not subject to state sales tax. And then there's utilization exemptions. So the big one is manufacturing. Most, if not all, states tax exempt in manufacturing, but you need to collect a manufacturing exemption certificate from your customer. In addition to that, there's research and development, sales to utilities, agriculture, mining, and dairy are typically not exempt, are exempt from sales tax. But the big one is manufacturing. So if it's used in a manufacturing process, will not be subject to state sales tax. You need to get a sales tax, you need to get a manufacturing exemption certificate from your customer. Okay, next slide. Okay, thank you. Use tax. So use tax is complementary to sales tax. So if you purchase a product out of state and you're not charged a state sales tax, you need to self-assess use tax in the state where it's being used, if that state has a sales tax. So if you're in Florida and you buy a product through the internet and the seller doesn't charge you state sales tax, you need to self-assess use tax in Florida. If that item is subject to state sales tax. So that's the complementary for sales tax. It just levels the playing field for everyone within that state. So use tax, so typically a state agency that audits you, they typically have lots of assessments for use tax because smaller companies typically don't go through and see if they've been charged a sales tax and self-assess the use tax. Okay, so use tax is a complementary for the state sales tax. Okay, next slide. Okay, so you needed a physical presence to be subject to state sales tax. Up until 2018, then there was a big case called Wayfair versus South Dakota. And on June 21st, 2018, this US Supreme Court overruled its prior decision that required an out-of-state taxpayer to have a physical presence. It basically said you no longer need a physical presence. If you meet these economic nexus laws or sales threshold levels, you need to charge and collect sales tax. They basically said these economic nexus laws are constitutional. So if you meet the sales threshold levels, you need to charge and collect the state sales tax. Okay, so next slide. Okay, so Wayfair. So Wayfair is an online company selling furniture. I'm sure everyone is aware of that. So they didn't have any physical presence in South Dakota. So South Dakota had adopted economic nexus laws that said if you have more than $100,000 of sales in a state or more than 200 sales transactions in the state, you need to charge and collect state sales tax. So it went to court, and Wayfair said, well, I don't have a physical presence. That was the law of the land. I don't need to charge and collect state sales tax. And Wayfair kept winning, and South Dakota kept losing. And then it went through many appeals, and then it finally went to the Supreme Court. So next slide. And the Supreme Court said, held that economic nexus law, those sales threshold levels, to be constitutional. They said you don't no longer need a physical presence. You know, the internet has changed everything. If you have $100,000 of sales in that state, you have nexus. I mean, you're exploiting that market. So that became the law of the land in South Dakota. If you have sales of more than $100,000 or 200 transactions, you need to charge and collect state sales tax. So that became the law of the land on June 21st, 2018 for South Dakota. So what did all the other 44 states do? They enacted the same type of economic nexus laws, which are sales threshold levels. I think the only one that hasn't enacted them yet is in Florida. I still think it's within the legislation. But yeah, all the other states have enacted economic nexus laws, which are sales threshold levels. So next slide. Yeah, so most states enacted their economic nexus laws, and you need to charge and collect state sales taxes. You meet the sales threshold levels, and typically those become effective October 1st, 2018 or January 1st, 2019. And if you were supposed to charge and collect state sales tax because you met these sales threshold levels, and a couple of years has passed and you didn't register, you can go through a voluntary disclosures and pay the tax there, and you won't get charged penalties and interest, and you can register. Okay, next slide. Okay, so here's all the listing of all the sales threshold levels by state for these economic nexus laws. So you should monitor your sales in a state, and if you meet these sales threshold levels, you're going to have to register for sales tax in the U.S. For example, Alaska, their economic nexus law became effective March 1st, 2020. You need 200 transactions or $100,000 of sales in that state. Once you meet that, you need to charge and collect state sales tax. So typically these are measured based on the last year or in the current year. And once you meet these threshold levels, you need to register with the state. Now they give you some time to register and implement with the state, but that's how it works. So the big one. So you need to monitor your sales in the state. So the big one is California. That's $500,000 of sales in a state. Most of them are $100,000 of sales in a state or 200 transactions. And you can go through this list. You need to monitor your sales in a state. So if we can go to the next slide. So these are just a continuation of the sales threshold levels. So the other big one is California, New York. So you go to the next slide. So New York, you have to have a lot of sales. So New York, you need $500,000 of sales in a state and 100 transactions. The other ones are typically or. But this one in New York, you need $500,000 of sales in a state and 100 transactions. So that's just a higher hurdle to cross. And next slide. And the other big one is Texas. So the big ones are the big states: California, New York, Texas. Yeah. So you go through, monitor your sales by state, and you can refer to this list. So next slide. Okay, this is continuation. Next slide. Okay, so like I said, you needed a physical presence, and then Wayfair came along in 2018, and it's based on sales threshold levels to level the playing field. So internet companies weren't charging and collecting state sales tax because they wouldn't have had a physical presence. So these Wayfair rules changed all that. So who are all the winners and losers as a result of these Wayfair rules? So the winners are state and localities because they're going to get more sales tax. Bricks and mortar retailers are big winners because they were already charging the sales tax. Now the internet people have to charge and collect the sales tax, so it levels the playing field. And software compliance companies, because if you're going to implement a sales tax, you need to buy the software from the software compliance companies that help you calculate the state tax. There's 45 different states, and each, like I said, the tax depends on the jurisdiction. So you typically buy the software. Losers, online retailers, because they weren't charging state sales tax up prior to these Wayfair rules because you needed a physical presence. Startups, marketplace providers, that's like Amazon, they have to charge and collect state sales tax. And foreign sellers. So a lot of Canadian companies were not, prior to Wayfair, were not charging and collecting state sales tax because they wouldn't have had a physical presence in a state. So Wayfair certainly changed all that. Okay, next. Okay, so like I said, you should monitor your, like if you don't have a physical presence, if you're selling online, you typically don't have a physical presence in the state, so you won't meet that physical presence test. But you should monitor your sales by state. And then once you meet these thresholds, you need to register with state and charge and collect state sales tax. And at the bottom it says accounting and due diligence consideration. So if you meet these sales threshold levels and you should have been charging state sales tax and you're not, and you try to sell your business, you know, if a buyer does due diligence, this will certainly come up. So they will, depending on you know, the exposure, they'll try to reduce the purchase price. And similar, if you're going through an audit, you get an audit of financial statements, and you should have been charging and collecting state sales tax. Well, your auditors might book a sales tax liability. Finally, I just want to talk about Amazon. So if you're selling through Amazon as the third-party seller, typically Amazon was not collecting the sales tax because they weren't the seller. They were just providing a marketplace, but they had control of the billing, and the third-party seller was supposed to charge and collect the sales tax, but they don't have control of the billing. So no sales tax was being remitted selling through Amazon. And then a lot of the states implemented these marketplace facilitator laws. And they said, regardless of who's selling, if you're a marketplace facilitator like Amazon, you need to charge and collect the state sales tax. So I think there's about 5 or 6 states that don't have it, but the rest of them do. So Amazon does collect this charge and collect the state sales tax in those states that have marketplace facilitator laws, which is a lot of them. So if you're selling through Amazon, you're probably okay because Amazon's charging and collecting the state sales tax. There is some exposure to about 5 or 6 states that are not, that no sales tax is being remitted. But certainly if you're selling through Amazon, you should find out exactly what their agreement says. But typically, they're the ones collecting it under the marketplace facilitator laws. So that's it. I think what you should get out of this is these sales threshold levels. So go through that list. You monitor your sales. If you meet these sales threshold levels, you need to charge and collect sales tax if the item that you're selling is subject to state sales tax in that state. That's it from my end.
Awesome. Thank you so much, Annie and Tony. Great information and wonderful examples. Really insightful presentation. So thank you again so much. We'll now open it up to questions. So if you have a question, please use the question box in your participant panel to ask your questions. It looks like we already have some that have come in. How long does it take to get your GST HST number? It used to take 30 days or so. Is it still as long?
Great question. Normally, if you already have a business number, so you already have your 9-digit business number at the time of incorporation, for example, then generally you can just call it in. You can call the CRA and they can give you a number over the phone. It has to be the owner or the director that calls into the CRA to obtain that GST account number. If you're going to be doing it through paper, like application and sending it in, right now, I think, you know, it's a bit of a crapshoot because of CRA is just slowly getting back into processing these registrations. But as long as you have submitted the registration date within the 30 days that you want to be registered, our experience is that the CRA will always honor the date that you put on the application. So for example, if I wanted September 1st to be my registration date for the GST HST, I will have to have confirmation or sent in by mail or fax to the CRA by September 30th.
Great, thank you, Annie. It looks like we have a question that's coming through regarding online course content. Is that considered a physical product?
So for the Canadian sales tax, if it's an online content, it's considered to be intellectual personal property, or IPP, because it is something that is done through online that is an intellectual personal property as opposed to a product. So then you would look to the rules that are applicable to the sale of IPP, intangible personal property.
So in the U.S., we'd have to take a look at it, but it looks like it could be a service. So you look at specifically at the legislation in that state, but it sounds like it could be a service, and a lot of services, those type of services are not subject to state sales tax, but certainly you would have to look at the legislation in that state.
Great, thank you. How are the U.S. tax laws affecting Canadian online sellers shipping into the U.S.?
Yeah, again, the Wayfair rules came into play. So if you meet these sales threshold levels and you go through that list, typically it's $100,000 of sales or 200 transactions. Once you trip over that, exceed those, then you need to charge and collect state sales tax. Whether you're a Canadian company, a U.S. company, you're selling individually.
Great, thank you. How is artwork taxed, both digital and conventional?
So for artwork, if it's a physical, tangible piece of artwork, then that would be viewed as just tangible goods. Then you would look to see what are the rules for selling the tangible goods, versus if it's an online or download image, then it's most likely be considered as an IPP, so it's an intangible personal property. So it really depends on, like I mentioned, you need to characterize what is the supply, what is the nature of the good or service or the property that you're selling. That will drive the tax application for Canadian sales tax.
Yeah, so in the U.S., if it's physical, it's going to be tangible personal property, and it's going to be subject to state sales tax if that state has a sales tax. And so these are the ones like art that if they don't charge you the sales tax, you need to self-assess. if that item, if you're using it in a state, but if you're not resident in the U.S., that's not going to apply. But if you're buying it and the seller didn't charge state sales tax, those are the ones that you really need to self-assess. Whether it's digital, you'd have to go state by state. So each state has their own rules on digital content, and that's very state specific. But certainly if it's a physical, it's tangible personal property, it's going to be subject to state sales tax.
Great, thank you. What about Canadians doing design work for a U.S. company? For example, it's a service versus a product.
Yeah, so design work, that's typically services. And like I said, a lot of Canadians that are providing services, it's that type of service. It's design work, it's consulting, and those are typically not subject to sales tax. So consulting, design work are typically not subject to state sales tax, but there could be one or two exceptions. So you would look at that specific state, you would look through the legislation to see if there's an exception. But generally speaking, that would not be subject to state sales tax.
Great, thanks. We have another question regarding, I guess, selling to other countries, such as the UK. How would you charge tax?
So on the GST side, it really depends on where legal delivery takes place. So although your customer may be physically located in the UK, if they're the ones who are, coming into Canada to pick up the product and then subsequently export it, what I would suggest to most of my clients is charge the tax until you get the export documentation. Then at that point, it becomes an exported sale because then it's left the country. And what you would want to do is keep those documentations on hand to show that the goods were exported. Then you do not need to charge tax on those because it's considered a zero-rated sale. It's an exported sale. If you're the vendor who's responsible to ship it to the UK, just like my other example on my presentation, as long as you are delivering outside Canada, you're responsible to ship it. You have all the bill of lading, customs work, customs brokers work, paperwork to show that it's left the country, and that's considered a zero-rated sale. So it's taxable, but at 0%, so you don't charge any GST, HST.
Wonderful, thanks, Annie. Is there any compliance software available for the Canadian market?
So I think maybe the ask is whether there's any software that would track or set up the tax rates properly. My understanding is that I think QuickBooks does do that, and there could be other software out there that would be useful to track and charge the tax properly. But I know QuickBooks does do that, so that's something to consider.
Great. This is a GST HST question. Do we have to consider gross total sales or net total sales amount to check whether we reach that 30,000 threshold for the GST registration?
Yeah. Great question. It is the gross amount, so it's before your expenses. So the 30,000 is on the actual your revenue amount that you will need to look at.
Perfect. We have a question asking if you can repeat the BC Manitoba thresholds for PST.
Yeah, sure, happy to. So for those provinces, they really look to a number of factors to see whether you're selling goods or taxable goods or services on a regular and continuous basis. So there has to be an intentional effort to sell in those provinces. So if you are responsible to deliver or ship the product to a customer in those locations, you accept a purchase order from a customer in that location, you solicit. So if you target a market in those provinces via like a website that's directly attracted to the BC or Manitoba customers, or if you put out an ad on the newspaper or on a website that's targeting the BC customers, or if you hold inventory in those provinces for sale to those customers. And again, the PST is a retail sales tax, so it's a B2C sale. So if you meet those conditions and you're doing these activities on a regular, continuous basis, so not just like a one-off sale, then you're most likely required to be registered for those provinces.
Great, thanks, Annie. Another HST question. So for HST, is that on a rolling 4-quarter basis? So example, the 30,000 in sales can bridge over 2 calendar years?
Yes. So you have to monitor the 30,000 on a quarterly calendar basis. So for example, so we're now into Q3 because we're in September. So say in Q1 and Q2, you were still under the 30,000, but then all of a sudden today you received a big order where you've hit over the 30,000 threshold. So say you were making 10,000, and then today you made $11,000 order. So today, September 10th, today will be the day that you'll be required to be registered. And what you will want to do is, get your registration number with the CRA. You would need to charge tax on the sale that's being made today, because today's the day that you've hit over the 30K.
Great. Another question here. How do we consider tax collections for drop shipping business in multiple countries, including US and Canada?
So for drop shipment, I think you have to look at the agreement to determine who's responsible to deliver the goods. Generally for drop shipment, for sales tax in Canada, it's depending on where is legal delivery, right? So if you're drop shipping goods, somewhere in Alberta because a customer calls you and said, I want you to ship it there, then GST applies. Versus you receive an order from a company in Ontario and they want you to drop ship it to their customers in the US, and you're responsible to deliver those goods to the US, and that's considered to be an exported sale because delivery address is outside Canada. So you wouldn't charge GST or GST on that. But I think it really depends on the detail of the agreement and the terms of the agreement. So those have to be looked at carefully to make sure that the vendor is not offside on charging the tax properly or not.
Great.
Yeah, so on the US side, I agree. You would have to look at the agreement and legislation, and then it's going to depend on the customer, where is it being delivered to, and then if you meet those threshold levels again.
Fantastic. We have another question. I need to complete my annual return for my business. I'm a startup and haven't made a sale yet. How do I report a report with no sales?
Yeah, that's as long as you're registered, you do have a requirement to file a return even if you've not made a single dollar sale. So what you would file is a nil return or zero revenue reporting. So you would have revenue zero, you have HST payable zero because you didn't collect any tax. But say if you've incurred some inputs where you paid tax, so say you hired a lawyer to help you incorporate the company, or if you had purchased equipment where you've paid HST, and as long as those invoices are issued out to your company's name or the registrant's business name, then you can claim those back as a credit. So you would in turn get a refund of the tax that you've paid in that period, even if you've not made any sale in Canada.
Great, thanks, Annie. Another question here, do I need to register a business first as a sole proprietorship or similar, or can I just register for GST, HST as an individual?
Yeah. You can, so depending on how you set up your business, the structure, you can be a sole proprietor versus an incorporated entity. If you are registering as an individual or a sole proprietor, what you will need to do is apply through using your social insurance number, and then a business number will be assigned to you by the CRA. And if you're incorporating an entity, what happens is under the Incorporation Act, your lawyers will usually help you get a business number. So it's that 9-digit business number that's been assigned. And once you have that number, what you will need to do is contact CRA and ask that you want a GST account to be opened under that same business number.
Great, thanks, Annie. We have time for one more question. Are there taxes required for bottled seasonings, herbs, and spices? This is for an online business.
So I'll just speak generally in terms of seasoning. So if these are for like human consumption or kind of like grocery, like food kind of items, food products, seasoning for food products, then generally they would be considered zero rating products. So it's taxable, but at 0%, so you wouldn't need to charge tax on that. But it really depends on the ingredient of the herbs and the purpose of the herbs that's being sold. So, but generally, if I'm just buying, say, like salt or pepper at the grocery store, you wouldn't be charging any tax for that because that's considered to be basic groceries, which are non-taxable for GST, HST.
Great. Thank you. I do want to be mindful of everyone's time. I do know our speakers have other appointments. If we were unable to get to your question today, or if you think of a question after we close off today's webinar, on the last slide here, you have Annie and Tony's email addresses. You're welcome to reach out to them directly if you have any questions. You can also reach out to the Entrepreneur Center at BEC, that's BEC at brampton.ca, and we'll be happy to help you as best we can. If we don't know the answer, we typically know someone who does. So we're happy to follow up with you to get the answers to your questions. So lastly, I just want to thank all of the participants for joining us today. It was a well-attended webinar this morning, lots of great questions. Wonderful presentations. As I mentioned before, really loved the examples. It really drove home the message that you were trying to share with the participants. We are really looking forward to our next series with MNP that's happening this October as part of our Entrepreneurs Connect series. As a participant in today's webinar, we will make sure that you get invitations to those 4 sessions that are up and coming. We're really looking forward to working with MNP again. And lastly, just to thank MNP and Startup Peel for partnering with us on this webinar. We really can't run events like these without the support of our community partners. So thank you so much. Thank you everyone for participating. And as I mentioned, this session is being recorded and we will share the link to the recording, and we will email everyone a copy of today's presentation. So thank you again, everyone, for joining us, and we will be in touch. Have a wonderful day.
Thank you.
Thank you.